Welcome friends, let's start with another chapter, another interesting chapter, merger and acquisition. Normally, the legal persons often try to make a difference between what is merger and hostile merger, takeover. We don't make any difference, we only say one thing, the two companies should work together if there is a gain, that's all. Whether you call it AB or whether you call it company A makes no difference at all. So whether we say that A and B, two companies merge together, whether we call it AB or we call A or we call C, other than legal terminology makes no difference so far as finance is concerned. Why merger? The answer is very simple. The value of the combined company AB after merger should be more than the sum of the individual value of the two companies. Suppose A company is worth 5, B company is worth 6, and the combined company AB is worth 15. Then we say the 4 is the increase in the value of the two combined companies, and that's nothing else but called as synergy gain. So technically, whatever may be the reason, whether it is combating of competition or whether it is increasing customer base or whether it is decreasing cost or whether it is complementary resources of each other, one thing is very sure that all these things should contribute to increasing of synergy gain. That's for sure, and that's the final one. The reason may be, the underlying reason may be, as I said you, maybe decreasing competition, maybe increasing customer base, maybe decreasing cost, maybe anything. But then finally, there has to be a synergy gain. And this synergy gain is then shared between the two firms, A and B. That means the shareholders of both the companies should be gainers. You all know in legal terminology as well, for a merger to be approved, the shareholders of both the companies should approve in their individual meetings. I'm not going to legal jargons, but even in those situations we know that shareholders of company A has to make a separate meeting of their own, they have to make an approval to the High Court, and something like that. That means one thing is very simple and clear, that for a merger to take place, and for merger and for marriage, for a marriage to take place, both the persons should be ready. The fiancé as well as fiancée. Both persons should be ready, then only a merger should take place. So this is known as synergy gain. Next, if you start with question number 1, we take the examples along with the question itself so that you can understand it better. First, what is called the value of a company? The value of a company is its market value. And market value is nothing else but market capitalization, which is the number of shares outstanding multiplied by the current market price. That's called the value of company. If you start with question number 1 directly, and with this figures and examples only, we will be able to help you in a better way. Question number 1. Black company is acquiring company white. You can all go through the question. Black company is acquiring white. And the exchange ratio is fixed as 0.5. And the exchange ratio is fixed as 0.5. We need to find out what are the gain or cost associated with merger for both the companies. Let's go ahead. For black, the market price per share is 70. For white is 32. Number of shares before merger is 20 million and 50 million. So value of company A, the market price per share multiplied by the number of shares, which is 1400 million, 70 into 20. Exactly the same way we can say the value of company 2 before merger is 480 million. But as I said to you, the value of the combined company has to be more than the sum of their individual values. And so we find, given the question as well, that 200 is the additional synergy gain because of merger. So value of combined firm is 2080 million, which is sum of their individual values plus the additional gain arising only because of merger, 2080. So that's the value of the combined firm AB, which is 200 more than the sum of the values of their individual firms. Let's see who gains and by what extent. The exchange ratio. As company 1 is acquiring company 2, exchange ratio is the number of shares of company 1, 2 given against each share of company 2. Given the question is 0.5, so we directly say the additional shares issued to equity shareholders of company 2 by company 1 is 15 into 0.5. Each share, for each share of company 2, company 1 is issuing 0.5 shares. Company is not distributing any share from its own. Company is issuing new shares. So company 1 already has 20 million shares. Company 1 is now issuing 7.5 million shares extra of its own to the shareholders of company 2. So now the total shares becomes 27.5 million shares of company 1 after merger. We may call it black white company, we may call it company 1, 2, we may simply call it company 1 only, who continues to hold their own shares. So finally, 27.5 million is the worth of shares, total number of shares of company 1, 2. We call it combined or merged form. Out of which 7.5 million shares are held by the shareholders of company 2 in the new company. Shareholders of company 2, which were earlier the shareholders of company 2, they have surrendered their shares and now they have acquired 7.5 million shares of company 1. The combined company, the merged company, has a value of 2080, which belongs to 27.5 million shares, and as we all know, all shares rank pari passu. So we can say the value of 7.5 million shares is only this much. 7.5 divided by 27.5 into 2080. So this is the value of shares now held by shareholders of company 2 in the merged company. And these shareholders, they are already having a value of 480 before the merger. So we can say there has been a gain or increase in the value of shares to company 2 shareholders is 87.27. I'll just want to repeat again. These were the value of the shares held by ESH2, that is equity shareholders of company 2 before merger. Now they are having less number of shares, but the value of those shares is this much, which is 87.27 million more than their earlier value. And so that's the gain to the equity shareholders of company 2. Now, coming back to hardcore finance, others' gain is my cost. Company 2, the extent to which they are gainer, to the same extent we are loser. So if I represent the shareholders of company 1, then I have lost 87.27 because I have paid them more. 87.7 million rupee I have paid them more than what was their value before the merger. They were having a value 480 million rupee. Now I have paid 87.27 million rupee more. So that's my true cost. But still I have a gain. Why? Because by paying 87.27 rupee more, by paying 87.27 million rupee more, I have made a gross gain of 200 million. So, in fact, my net gain will be 200 minus net gain to equity shareholders of company 1 will be 200 minus 87.27, which is something million rupees. Let me just help you out with calculating it. It will be 200 minus 87.27. It is 112.73 billion. Although this question has not been asked, or question ends here itself, but still, just to make a proper understanding of the question, this 200 million of synergy gain has been shared by company 1 shareholders and company 2 in the ratio of 112.73 by company 1 shareholder and 87.27 billion rupee by the shareholders of company 2, and that ends about it. So this is the evaluation of merger proposal by valuation basis. This is valuation basis. Why merger? Based on the valuation basis. We have other method as well, but this method is probably the best one, and so we started with this only. That Y merger, who are the gainers? Gainers in terms of value. Net gain to company 1 shareholders is 112.73, and cost to company 1 is 87.27, which ultimately the gain to the shareholders of company 2. So we can directly say, in a simple understanding chart, is that 200 billion is the present value of synergy gain, additional gain. This has been shared by equity shareholders of company 1. They enjoyed to the extent of 112.73 million rupees, and equity shareholder of company 2 enjoyed 87.27 million rupees. So basically, it appears to be a win-win case, but still, equity shareholders of company 1 says that I have been gained only to the extent of 112.73, but I wanted 200 million rupee. So 87.27 million rupee is like a cost. Ultimately, they are gainer, but still, because their aim was to secure the entire 200 million rupees, and so finally the sharing takes place in this way. That completes question number 1. One of the quite most important questions for merger acquisition, highlighting the concepts as well on the basis of valuation. This is question number 1, which is over. We go ahead with the next question and the next concepts as well. We start with question number 2. We start with question number 2. You all have the time to read through, to go through the question. Question number 2. You all know that market price per share is equal to EPS into P ratio. Market price per share explained in terms of P ratio is EPS into P ratio. Here the company large is acquiring a company small. PAT given the question 56 lakhs and 21 lakhs. Number of shares also given 10 lakhs and 8.4 lakhs. Earning per share, just make a division, 5.6 and 2.5. Price earning ratio before merger is also given, which is 12.5 and 7.5. We can say applying this formula number 1. Market price per share before merger will be 5.6 into 12.5, and similarly here 2.5 into 7.5. Find the answers easily. The answer can be obtained very, very fast. 5.6 into 12.5, which is 70. In terms of lakhs of rupees, it is 70 lakhs rupees, and 2.5 into 7.5, 18.75 lakhs. 18.75 lakhs. Let's say what the company says. Determine the pre-merger market value per share. This part A is over. This is the answer. Direct answer. Part B says, part B has 2 parts in fact. Part B1. We want to find out the maximum exchange ratio at which EPS does not get diluted. That means the earning per share available to the combined company should be at least equal to EPS 1. So you need to find out the maximum exchange ratio so that EPS does not get diluted. Let's say maximum exchange ratio is X. So you need to find out what should be X so that EPS 12 is equal to EPS 1. EPS 1 already given to you in the question is 5.6. So let's try to find out how much is EPS 12 in terms of X. EPS 12 is, of course, total profit after tax divided by total number of shares. Total number of shares outstanding. Total profit, there is no mention about synergy gain at all. So you can say the total profits will be 56 plus 21 divided by the number of shares is 10 plus 8.4 into X. You can see here easily, for each share of company 2, we are giving him X number of shares of company 1. So for 8.4 shares, I am giving 8.4X. Just for understanding, say X is 0.5. So we can say 0.5 shares of company 1 is given against each share of company 2. So 8.4 into 0.5, that's 4.2 will be the number of shares given against what I was saying, that if X is 0.5, then one share of company 1 given against each share of company 2. So if there are 8.4 lakhs of shares of company 2, then I will be giving 4.2 lakhs of shares of company 1. So proceeding this way, we say EPS 12 is this. EPS 12 is this. And finally, we set up the equation that EPS 12 should be equal to EPS 1 at maximum exchange ratio. Solving it, we get 56 plus 21 divided by 10 plus 8.4x should be equal to 5.6. So it will be 6 plus 1, 7, 77 is equal to 5.6 into 10 is 56 plus 8.4 into 5.6. Answer is 47.04x. And so finally, we find the answers to be 0.446. Just to make an interpretation of this answer, the 0.446 is the additional number of shares of company 1 that can be issued against each share of company 2. Still, company 1 is able to maintain its earlier existing EPS of 5.6. So that's all about part B. And first part, we go ahead by the second part. Second part says that without dilution of MPS, without dilution of market price per share, we can directly say, so it is P12 should be equal to P1. That means the market price per share of company 1 after merger should not fall below the market price per share of the company 1 before merger. MPS 1 was EPS to P ratio, which was 70, not 70 lakhs, but 70 only. Please, you can correct it. MPS is 70 rupees per share. So 5.76 into 12.5, which is 70 rupees. We say the exchange ratio should be such that the market price per share after the merger does not fall below 70 and touches just 70. Let's say the relevant exchange ratio is equal to Y. Now, we just take the reverse order of calculation this part. Let's see. First we compute V1, we compute V2, then we compute V1 plus V2. Let's do that. Let's do that. V1 is 70 rupee per share multiplied by the number of shares of 10 lakhs. The number of shares given are in lakhs. So you can directly say V1 is 70 rupee into 10 lakhs of shares, which is equal to 700 lakhs. V2 is 18.75 into 8.4. Simply compute it. 18.75 into 8.4. The answer is 157.4. So V1 plus V2 will be 700 plus 157.4 plus 0 because there is no present value of synergy gain. So this is the market value or market capitalization of the two firms taken together, and in absence of synergy gain, the value remains the same. Now the question says that the market value per share after the merger should remain at rupees 70 only. So let's try to find out that if market price per share is to be maintained at 70, then what is the total number of shares after the merger which is possible? So we directly say it is 857.4 lakhs divided by 70, which is equal to 12.24 lakhs of shares. So if the company after merger just has a 12.24 number of shares, 12.24 lakhs of shares, then the market price per share will not fall below 70. But company 1 shareholder already has 10 lakhs of shares. That means the additional shares that can be issued by the shareholders of company 1 will be equal to 12.24 lakh shares minus 10 lakh share, which is 2.24 lakhs of additional shares of company 1 that can be issued against the shares of company 2. And these are shares issued to the shareholders of company 2. So what is the exchange ratio? So exchange ratio will be directly 2.24 lakhs of shares divided by the number of shares of 8.4 lakhs. And if you compute, the answer turns out to be very simple. 2.24 divided by 8.4, answer is 0.26 or 27. So we finally come to the conclusion of the answer is that if the company issues 0.27 shares of company 1 against each share of company 2, then the MPS of the combined company will not fall below 70 and will just touch rupees 70, which is a requirement because the question says the market price should be maintained without dilution of MPS. And naturally, company 1 survives, company 1 loses its legal existence, and all the shares of company 2 are being given shares of company 1. And so, to maintain rupees 70, 0.27 is the additional number of shares of company 1 that can be given or issued to the shareholders of company 2. That completes question number 2.